Let's bring in Daniel Janis. He's a senior portfolio manager at MFC Global Investment Management, and this week's Best in Class. He is the lead portfolio manager for a Bloomberg Best in Class Global Bonds Fund, the John Hancock Strategic Income Fund. Dan, good morning.
Good morning. How are you, Carol?
I'm doing well, and it looks like the concerns over European debt are well, or better, I should say, this morning than they were earlier in this week. How worried, though, are you about that sovereign debt over in Europe?
Well, the last time I think we talked about this, we made a conscious effort about 18 months ago in our foreign bond bucket, which was our high-quality portion of our fund, to avoid that location and wait till we get better color on that market. And right now, we are getting, pluses and minuses every day, but I don't think the risk rewards for our fund right now make sense. There are other opportunities around the globe that we think can get a better total return with less risk.
So to hear that Norway is buying Greek, Spanish, Italy, Portuguese debt, that doesn't sway you at all?
Well, it makes me a little bit more comfortable that we have a high quality, sovereign wealth fund that now is starting to participate in that market. But for us right now, there's some other opportunities, high yield and emerging market, local currency debt that on a total return basis with a better risk reward that makes sense to us.
All right, and let's talk a little bit more specifically about those opportunities, Dan. If you could kind of drill down and be more specific about where you guys are finding opportunities and really putting money to.
Sure. We're truly a global bond product, and we traverse in three different buckets of assets: treasuries and mortgages, credit market, investment grade and high yield, and then the foreign, which would be foreign governments and emerging markets, and they can be denominated in dollars or non-dollars. We think still the best opportunity for us is to be overweight high yield. We're getting incremental spread over treasuries of between 650 and 700 over, and the emerging markets, especially Asia and Brazil, where we're getting again some income over U.S. treasuries together with a currency kick that we think has good risk rewards tied to that.
Hey Dan, what about corporate bonds, the corporate bond market, or is the potential for more regulation, more scrutiny, more taxes making that a little bit more complicated play at this point?
Yeah, we're underweight the high-grade market due to the fact that spreads have compressed significantly. And when we looked at the return horizon relative to high yield, we thought that high yield would return a better, total return. And we were right over the last year and a half. And also, there's an interest component on the corporate bonds that down the road we think over time that rates could gravitate higher in the U.S. and we don't want to have that interest rate risk. Where in the high yield and emerging markets, if rates do go up because the world gets a little bit better, then they're going to grow with the economy, and those should perform better than an investment grade bond.
Don, 5 seconds here, Dan. I mean, treasuries, any play here? And got to be quick for me.
I'm underweight treasuries, and I'm short the 10-year future right now. I think rates go higher.
All right, that was quick. Dan, thank you so much. Dan Janis, Bloomberg Best in Class for the John Hancock Strategic Income Fund. Dan, thank you.